This is the White Tiger Knight YouTube channel, options 1001. These are E-Trade Pro options chains. I'm using this for informational purposes only. Alright, you can see the calls and the puts for Apple. Apple's trading at around $5.93. Okay, the strike price, the calls are on the left, puts are on the right. Strike price is $5.90, you see $10 and $9 respectively. $10 for the puts, $9 for that. For the calls, these are the expiration dates, and this is Apple trading at $5.93. You can see there's weekly expiration dates and monthlies. These are the monthlies, that's the weekly. Okay, and you can see when you change the expiration dates, if you remember the price, now these
at the money.
Remember, it's $5.93, so now it's $5.90, $5.95. It's $19 and $18, so it's almost double the price. That's only going out 1 month. So you come back to August here, and you can see $9 and $10. Alright, these are for the calls and the puts. Again, going out a little farther, this is 2 months, they go to 26 and 27. So the more distance you buy in the market, then the more expensive the right to buy and the right to sell these specific stocks will become. And I'll explain that in a little bit in future video, and coming up in the video. Now, again, you can see here, the different months, again, the expiration, and the theta, and the gamma, and the delta. I'll talk about that in different videos as well, but this is just the 101. White Tiger Knight Options Tutorial 1001. Should be 101, but I got an extra 0 in there. Alright, the first thing you need to know is the stock price, the strike price, and the expiration date. And this right here will determine the most important thing of all in options, the premium. Once you determine the premium for the C calls and puts, you can determine your strategy until expiration. Now, say for example in our hypothetical scenario here, the stock price is 30. Your strike price is 30, meaning that gives you the right to buy with the calls or sell with the puts this stock at 30 until the expiration date. Okay, so the stock's at 30, strike price is at 30, your expiration date in this scenario is 1 month, so your premium is about $2 for the calls and $2.50 for the puts. Now if we switch this up and we change the expiration date to 2 months, the premium would not necessarily double, but in the hypothetical scenario will definitely go up to, let's just say, $4 and $4.50 for the calls and puts respectively. Now, if the premium, let's just say the expiration date stays the same, we have the 1 month expiration date, but the stock price changes. The stock price decides to rise. Say it rises a lot, say to 50. Now, the premium for the calls and the puts, say we bought them here for $2 and $2.50 each. The premium for the calls will rise because you have the right to buy this stock at 30 and it's trading at 50. So you got $20 right there of profit, and that will be shown here in the premium. So you'll have plus 20, say 22, whatever it is, but definitely in the $20 area. And the puts, which give you the right to sell this stock at 30, it's trading at 50. You can sell it at 50 right now. Why would you want to sell it at 30? You don't. The puts are at 0. The most important thing to note here, though, is that your risk with the puts was only $2.50, okay, per contract. So if you do the math out right here in this scenario, you would have went from $2 on the call to $20 on the call, which is plus 18, from $2.50 on the puts to $0 on the puts. Okay, so you only lost $2.50 there. So you made 18, but you only lost $2.50. So your risk is limited. You're positive $15.50 net from $4.50, which is over 300% with low risk. Alright, let's switch it up a second. Let's just say the stock price falls to 10. Okay, something bad happens, and let's just say it falls to 10. Again, the stock price falls to 10. Your strike price is still 30. Okay, you bought back here. Your 1 month's coming up, and the calls and puts. What happens? Say the calls go to 0. Okay, again, because it gives you the right to buy it at 30. Why would you want to buy it at 30 if you can buy it at 10? You don't. Okay, but you would want to sell at 30 if it was trading at 10. So you can go on the market, buy these shares at $10 and sell them at 30 with these puts. That's why the premium will be represented in probably a plus 20, because again, that's the difference in the price here. Pretty simple stuff. Most people try to make this real complicated. I think it's really easy to understand if you can just understand it. Again, now this is in a graph form. Stock's trading at 30. Say it piles up. This is the expiration date. These calls only work until expiration. At expiration, they will go to 0. So if the stock is still at 30 at expiration, you lose your premium, 100% of your premium. If you just fall asleep and you don't trade and you forget, and then as Batman did, if you see the recent movie, bought a bunch of put options right before expiration, they all go to 0, no matter what. So you got to be careful here and make sure you understand your trade. But again, say 30 to 50, you sell the calls. And you can just leave the puts, they're probably at 0. 30 to 10, you sell the puts, you can leave the calls. If it's trading, it's interesting to note though, if it's trading at $30 on expiration, you lose probably 100% of your premium because nobody's going to want to buy the right at 30 if they can just go in the market and buy it at 30. So that is Options 1001 from the White Tiger Knight.
YouTube,
Signing out.
the White Tiger Knight.